we're going to start off with some trivia because what webinar would this be without trivia? So there should be 3 questions on your screen right now. We're going to give folks a couple of minutes to answer these questions, and I'll just answer them together, or I'll go through them together with you. So the first one is that street rates across the top 50 markets peak in May, and they trough, or their lowest point is in October, um, and through December. How big is that difference? Like, what percentage point is that difference? The second is what I posted yesterday. How much lower do independent operators charge their 10 by 10 versus the market average? And I think we'll look at a deal today from Cole that might fit that bill. And then the third question is, only one unit type posted a street rate decline year over year. Which unit was that? So I see there's a bunch of responses coming in, and encourage folks to continue answering. And we'll give folks another 20 seconds before I roll in and hit you guys with the data. All right. Well, you only had 1:40 seconds, which is perfect amount of time to think through these overly complicated trivia questions. So for the first question, how big is the delta between the peak and the trough? It's about 10 percentage points, which is actually a pretty big deal. So as we learn from our wonderful guests today, especially Melissa and Tim and Karan, pricing a unit in May and pricing a unit in December, very different projections, very different expectations. In terms of independent operators versus the market average, it's actually a 16% delta in percentage points, which looks like 38% of y'all got that correct. And 38% of y'all also got the first question correct. So what about the third one? Which was the struggling or unit type in self-storage? It was actually the 5x5 climate control. We can have a whole, only 3 of you got that correct. Can have a whole debate, which we did last year for our almanac, around why smaller unit sizes are struggling more than the larger ones, but that'll be another topic for another day. So what I want to do now for the next couple of minutes, and I'll just go and quickly hit on what the agenda is today. So I'm going to walk through a couple of really cool product updates on the TractIQ side. We're then going to dive right into a deal from a 95+% occupied facility in a pretty good market from a mom and pop operator that hasn't hit the market yet. Cole is going to walk us through that, and we're going to underwrite it together. We're then going to turn it over to Melissa from Storage Pro, who is going to answer the question, if you took over management of this asset today, what would you do? How would you price it? And then we have our friends Tim and Karan from Tenant. They're going to show how you can actually change the pricing of units in Hummingbird with our awesome new integration. And then we'll talk about we'll summarize everything. We have some giveaways, and then we have some announcements as well. The last thing I would say is, for every one of these segments, instead of waiting until the end for questions, we're going to allocate however much time needed in each section for questions. So if you have a question for Cole about his deal, or a question for Melissa about operations, or a question for the tenant team, feel free to write it in that chat as we go in, and then we can answer that on the fly. All right. So with that, I want to talk about 3 quick, cool highlights on the TractIQ side, and then we're going to dive into Cole's deal. So what I think is really cool, last month we launched over $500 million of deals in TractIQ, put together by wonderful broker partners, such as Cole from Argus, amongst others. What we launched last week, I think, is really, really interesting and data that I don't think has widely been available before. So what I'm going to do is I'm just going to pretend I want to build a buy box. So let's pretend I'm looking for deals that are $1 million to $7 million that are at least a 5 cap. Maybe the occupancy percent is at least 55%. Maybe the square foot per capita is 10 or less within the 3 mile. And I'm looking for value add, stabilized, and lease up deals. I can actually save my buy box and very quickly filter and find all of the deals that match my buy box. This is really cool for a lot of reasons, but what we launched last week was a tool in our AI connector that can actually connect to your buy box and look at all the deals in TractIQ and actually help automate that underwriting process for you. So I'm going to pause and let this run, and we're going to come back to this. The other piece of this is we had a new launch 2 weeks ago that I think is really cool. Where now, for folks who are looking for prospecting, whether you're a broker or trying to find off-market deals, in TractIQ, you can actually now filter for all the facilities that have loan maturities that are coming up. So let's say in this case, I'm looking for facilities that are operating, that have owner information, that are non-REIT managed, and now have an outstanding loan with a mortgage that'll mature in the next 18 months or so. I can actually now save this as loan maturity list. And in this case, I can actually filter across all 70,000 storage facilities and create a list based on all of this. So I'm going to come back to this in a second. Well, I guess in this case, it's already created. So this is actually that list. And in this case, in 30 seconds, I just created this prospect list of all these storage facilities in the US that match that criteria. I can see all of this information about every single storage facility, such as square footage, owner contact information. But what we launched a couple of weeks ago would be all the way to the right, would actually be mortgage amount, mortgage due date, and who the actual lender is on all these facilities. So you can see when all these facilities maturity dates are coming up, and you can prospect in that sense. And then, of course, while I was walking through that, my Claude finished up. And now, if I look at all of the deals on the market in TractIQ, you can kind of see across all of these deals, it actually ranked all the deals based on my buy box that we just created together on this call. It showed price, cap rate, occupancy, price per square foot. And now I can dive into every single one of these deals and start to underwrite them. Lots of really cool updates. Again, our goal is to help you find, underwrite, and benchmark your portfolio and your growth. So we're excited to now talk to some incredible folks to help us all learn, improve, and find better opportunities. And with that, I'm going to turn it over to Cole, because Cole, apparently you have a deal that has not hit the market yet that you're going to share to all the folks on the call.
We do. It's going live next week, but exclusive here on TractIQ. First of all, Noah, thanks for having me. Just wanted to say, as well, to you and the whole team, the platform that you guys have built over the past, call it year, the improvements you've made, how much I was using TractIQ a year ago compared to today, and that's not a dig on where it was a year ago. It's more a testament to the work that you guys have put in. It's exponentially higher the amount I'm using it, that we are using it at Argus today. So kudos to you guys. Obviously, there's a reason why, on last month's episode, Argus is leading the amount of volume on TractIQ. It's because we believe in the platform and the product. So thanks for having me. So we're gonna hop into Donovan Road self-storage. So this is a deal in Santa Maria, California, south of San Luis Obispo, north of Santa Barbara. Um, it gets some high-level stats on it, right? It's a mom and pop managed asset, roughly. Yeah, hey, if you want to go to page 8, Noah.
Awesome. I'll do it.
Um, about 48,000 square feet, 473 units, so an average unit size of roughly 100 square feet. It is 99% occupied. Um, so, very highly occupied. We'll hop into that. I'm sure Melissa will dig into that as well. Mom and pop managed, as I said, no real revenue management strategy to or in place that's been implemented. They are, as we'll talk about as well, what we perceive using TractIQ, roughly 20 to 25% below street rate. And then we'll hop into the rent roll as well. But the rent roll on top of that, we believe there's a variance about $3,000 per month in the rent roll compared to street rate. Um, and what else? We're in our pricing guidance here is going to be $7 million, so $146 per square foot roughly. We think, the upside with the street rates coupled with the basis play in a market like, yeah, or in a state like California, Santa Maria, will be highly attractive. There is a good, high barrier to entry story here. The square foot per capita in the 3 mile is, 4.5, 5. When it gets into the 5 mile, it gets closer to 10. But there are some barriers to entry in this market in terms of just the land that's surrounding Santa Maria. The Santa Maria as a market itself, we think is the story there is very attractive. As I said earlier, it's below San Luis Obispo, above Santa Barbara. So in terms of just like a demographic perspective, it's a much cheaper option to live in between those two kind of higher demographic areas. Sits right off the 101, so it's really right between there. But you're still kind of utilizing the same coastline. There's a lot of attractive small beach towns very close by. Avila Beach, Pismo Beach. So again, you have the access to the beach and the coastline, but at a much cheaper option in terms of where to live. There's a couple of kind of workforce drivers here. The main one being Vandenberg Space Force Base. That Space Force Base has continued to see the amount of jobs and economic impact. It's a little farther south, closer to the coast, Noah.
Gotcha.
Um,
Gotcha.
has continued to see,
Right
a
over here.
rise in, again, economic impact. There it is, yeah. Um, Firefly is increasing the amount of, flights it's going or launches that's going out of there from, 3 to 5 this past year to 6 to 10 they plan to do 24 a year going forward. So, kind of all of these things combined, think that this is a really attractive opportunity. There are REITs in the market, but is a predominantly what I would say mom and pop managed type market or competition. And so all of those combined, make us feel that this is a attractive asset for a buyer, but mainly due to the fact that the tenant base is in place, 99% full. There's variance in the current rental to street rate, and then the street rate variance between the market. Again, we view it as roughly 20 to 25% below the market. So, that's kind of my high level walk through the deal. And Noah, if you have any questions or anything else I can answer on that, happy to.
I love it. I love it. So to me, this is a deal that a lot of people would say they're looking for. So I want to dive into this and better understand this to help folks who uh, are trying to understand this market in a more granular way. But that was a great overview and seems like a really cool opportunity. If I look at this market, I think first question is you mentioned the topography and kind of the
Yep.
barriers to entry. Is it really based on topography? Like you literally can't build because this area is mountainous, um, and or are there actually like zoning implications where the city wouldn't want to approve new storage? Like how should someone think about that?
Yeah, it's both. Like to the north, you have the river that you can kind of see running there, and there's ag land to the east and west, as you can kind of also see there. You know, it's kind of like all the ag plots there, and then to the south is unincorporated. So you really kind of are in a way landlocked, and then you know going even farther north, you can see the mountains there, right? So.
Hmm.
This is a story of really more like infill than expanding. There's not really a lot of area to expand, at least as it relates to the city center. And the city, you know, there's not much land left in the city to build on. They are trying to fill that land with housing because of the expansion of the Space Force base that I mentioned. They roughly have, you know, 5,600 units, you know, planned upcoming already. That's taking most of the land that's available for you know, development. Self-storage is a, you know, right, you know, it's a conditional use. So the point being is it's kind of all that combined, Noah. There's geographical barriers, there's barriers with the city, and the city's more focused on supplying more homes or you know multifamily ADU units than they are self-storage. So again, all that combined, you're kind of insulated from development a bit.
Yeah, and it looks like there's a $174 million 524 unit housing
Yep.
project coming in addition to some others. I think what really struck me about this market is generally pretty positive data. So, you know, you just look at this market over the last year, you can kind of see like the market average has ticked up quite a bit. And even like looking at the last 5 years on average, it's been a pretty stable market compared to the rest of the country. I think what was also pretty unique was in this market, there's actually, you know, we have actual occupancy and achieve rate data on a couple of facilities in this area, including one that's 0.85 miles away, um, and an extra space that's 95% occupied as well. So, you know, the fact that your facility is 99% occupied and is below market rates compared to this extra space that's 4 miles away that's also 95% occupied. Um, I think that shows really well. Before I gotta go into the memo that I built, Taylor, is there anything else that we would want to ask or folks would have questions on around this deal?
Yeah, I had one. I think we talked a little bit about that farmland kind of up north
Hmm.
to the property. Uh, we talked about how that's kind of a positive for new development. But I guess I would wonder, Cole, what your thoughts are on how that affects demand. Like the property appears to be a little bit on the outskirts of town or at the edge of town rather. Does that affect demand? Is that concerning? I would just love to hear your thoughts on that.
Yeah, for sure. I mean, I think it cuts both ways, right? I mean, to your point, there's no population up there, but there's also no development. So I think that overall keeps things in check. You know, as I mentioned in general, all the new development is kind of going on the other side of town, you know, kind of more south. That's the only place where you can develop. So I think you're again somewhat insulated to. So you know, again, it kind of cuts both ways. I would view it as a positive as that there's no real room for new competition, and your demand base is already there and in place, and the existing leftover land that is developable is more for, you know, multifamily or housing units instead of self-storage.
Yeah.
And the last question, why does the seller want to sell? And I think like if you look at a 99% occupied facility, I can't imagine that, you know, I can only imagine how excited Melissa would be to get into a property like this, which we'll wait for her to give her spiel. But what is the, you know, did you have the conversation with the seller about why not try to run it in a more, you know, professional manner so that you can increase the value even more than where it's at today?
Yeah, I think it's just, you know, as usually in self-storage, you know, it's some sort of life event. This is a family-run deal. The family kind of lives all over. And I think that it was just, you know, they kind of came together and you know, the ones who they would call the asset managers. You know, it was just time to move on. No one was really, you know, paying attention to it too much anymore. And so it was just a kind of a family decision that um,
Mhm.
yeah, it was just time for them.
Awesome. We
Yeah.
have some questions in here. Matt, I'm going to come to yours at the end of this, but Bud asked, at what point do you do an LOI and start due diligence? Which I think is, maybe deal sounds really good.
Yeah.
We would always advocate to go much further than what we just did now. So, for instance, right, we can pull the occupancy and the P&L of the competitors. We're going to pull the rates of all the competitors in the market. We're going to pull the demographics. We're going to pull the saturation. We're going to pull all this data that we just talked about and summarize it into a presentation and a model. So this is what I built right before this call using our AI connector, where I looked at this deal with Donovan Road Self Storage. I went through the rent roll, right? I went through all the financial information that Cole provided and came up with, my own thesis on this deal that is definitely not investment advice. Please do not use any of this for that other than education purposes. But, I was looking at, okay, you've got a 99% unit occupied facility, 94% unit or economic occupancy. It looks like we're 23% below market rates in this area. The manager runs it really lean today because it's not professional managed. So you'd have to take that into account. But all of this I built in probably 15 minutes. So I looked at the subject rates by each unit type relative to the competitors. I looked at the occupancy of the subject versus the competitors, especially that extra space that's 95% occupied. I looked at NOI margins of competitors, looked at the trade area, and then I built my own projection pro forma model in Claude that you would want to make sure, does this cover debt service, right? Does this cash flow? How much equity would I need to raise for this deal? Could I get pre-approved by the lender, right? And there's varying degrees of folks on this call where you can be a institutional quality investment company all the way down to someone that's looking to buy their first facility. So, wherever you are on that spectrum, want to make sure you dive much further in so that when you talk to Cole, you can ask him a bunch of questions, which I would always advocate for. I wouldn't advocate for sending an LOI. I would advocate for Cole. I looked at your deal. I saw extra space down the streets 95%. I saw it's a high barrier to entry market. I saw it's 99% occupied with rates 20% below the market. There's no new competition coming into this area. The in-place cash flows would allow me to cover the debt in year two at this level. I can get pre-approved for this. I just wanted to ask Dusty your question. Does the manager live in a two-story building or who's the right? Because Cole, if I came to you and I said all of that, what would you think of me as a buyer?
I think that you did your research. And again, yeah, to your point, no, I always appreciate, talking to people on the phone, email, one-on-one, knowing that obviously with any deal that we sell, we want to make sure that, for our seller, we're producing quality buyers that have done their research and, do that work up front so that we can be confident. It's great getting a price and an LOI, but ultimately it only matters if the deal closes, right? So that's our
That's
general
right.
thought on that.
That's right. So I want to flow into Melissa. Right before I do that, the quick questions. So for the loan data, every Pro Plus, and Max TractIQ customer should have that in their account already for loan data. So if you don't see that, just send us a note, but it should be there. And then what prompt did I use to get this to generate the deal? I created a memo skill on our first webinar. But the prompt was, can you generate an investment grade memo using my memo skill using this address and this OM? It was very simple. So I would encourage you to look at our first webinar to learn more about like AI and how we think about the connector, or of course, reach out to us because we're happy to show you. But with that,
I'm
I'm going
sorry,
to stop sharing my screen.
there's one last
Unless,
question. Can the
okay.
automation be upgraded?
Let me respond in the chat, Bud, so I can better understand that question. I want to go right to Melissa, and then Bud, I'm going to send you a note really quick so I can better understand. But Melissa, please take it away.
Thank you, Noah. Appreciate you. I always love seeing the new stuff you guys are coming out with. It's truly amazing, to be honest. So of course, my question that was asked of me is, hey, if this deal comes to you, somebody says we want to buy it, we want Storage Pro to manage it, what does that look like? So I'm going to go ahead and share my screen quickly, just so everybody can kind of see, the primary goal, like when anything, hopefully everybody can see it well enough. When a property comes to us, like our job is to identify growth opportunities. Like it's a unique process for every single owner. When we work with somebody, we're looking at the market, we're looking at the owner, we're looking at the facility. It's just completely unique. And if you don't do it that way, it's kind of hard to identify what are these primary like indicators to grow revenue. So the three main ones that stood out about Donovan Road was one, we really need to be driving economic occupancy here. There's just a lot of money being left on the table. And I know this pains some owners to hear when I say it, but like high occupancy is a sign of like depressed NOI because you shouldn't be 99% occupied. The sweet spot is around that 92% economic occupancy. You're going to make more money. And, the financial health of your facility will be better. So how do we do it? We start with a rate analysis, right? So we use TractIQ, of course. We want to look at rates compared to, your competition. But one of the big things, especially with this property, and, ideally it'll show here, we looked at drive time. When you have geographical things and you're looking at, I don't know, depending on the market, sometimes rings won't give us the best view, which is why I love the TractIQ. Will allow us to not just be locked into rings. They say, hey, let's give you drive time options too. So drive time was one of the main things I looked at for this one because, obviously we talked about this a little, these mountains here, it's going to be real difficult. Nobody's climbing over the mountain to come rent a unit. So that's really how we started our rate analysis, was like trying to be realistic about where our the rates coming from, where our competitors, where are the tenants driving in from. So from there, we look for outliers, of course. You have those few people that might be charging like way over, way under, and they can skew your results. Now, when we modeled it, we were looking at rates about 17% under market. I know that's a little bit lower than what you guys said, and there's a reason why. We have to consider things like reputation management, rolling out new training. We have to consider tenant loyalty. You also have to consider like you're trying to generate healthy churn, but not to the point where, you're ripping the ground out from underneath everybody. So for us, we believe when we look at it across the board, still a huge gain, right? Like that's a huge gain. It's a lot more money. It's like around $40,000 in just rental revenue that's being left on the table for the year. But we did it about 17, and that's why, right? We want to keep your tenants happy. We want to keep owners happy. I mean, that's truly our goal. So then, once we identify these earning potentials, that's how we look to roll out our ECRI plan. We look at starting month, frequency, rate. It's really, we don't all love when we have REITs in our market, but I will tell you that a heavily populated REIT market means that you often have tenants who are more tolerant to ECRIs. They're used to it. And so because they're more tolerant, when you roll them out as, being managed, let's say by us, you're going to find that they're more tolerant, so you can increase that frequency.
Could I ask a question on that? I don't think
Yes.
I've heard that before, so I would like to dive in.
Yeah.
How do you know that? Right? Like is there data that you have that you've been able to see that more institutional markets actually can absorb more? Like I would be curious, how did you discover that?
It's based on how they model out their ECRIs. Like specifically, I won't name any of the REITs, but they have a set model for how they roll them out. And it doesn't matter necessarily by market at all. Like they're going to roll it out at 3 months, right? And so now you have a bunch of REITs in your market. The tenants only have so many facilities to choose from, right? And so because you have these REITs that are in the market, they're used to them, right? Because they're seeing, okay, well, every 3 months, I'm getting this new ECRI rolling out every 3 months. The other thing is, all the trends are also showing that like younger renters are more tolerant to rate changes. So, you can look at again, in this site report, which is so lovely that you guys put together for us. When you go down, you start looking at your demographics and you can start jumping in. I won't go through the whole report, but if you guys haven't seen one, definitely check out one of TractIQ's reports. If you see a younger population, you're going to find that they are more tolerant to rate increases, right? So those are some of the things we look at, because when we're trying to decide, hey, what month are we going to roll this out and how frequently are we rolling it out and at what rate, we are looking at things like, all right, what's the population? How tolerant are they? How old are they? What's the square foot per capita? A lot of that great demographic data that you give us really can lay the groundwork behind the scenes to roll out the plan to bridge this gap, right? And so that's what we do.
Melissa, we've got two questions here.
Okay.
First is from Taylor Surveys. And Taylor asks, from a revenue management perspective, do you believe it's best to offer 50% off X months while keeping the street rates high, or a lower move-in cost, i.e. with a free month, and maybe be more aggressive on ECRIs?
I love that question. I think if you don't tailor your concessions to your long-term goals, you're making a huge misstep. So if your goal is you want to get tenants in there and you want them to be long-term tenants, right? You're not just trying to get this spike in occupancy. I think you create that 50% off for 3 months, right? Now, you're generating revenue every single month. You don't have a month where it's just zero revenue because it's a free month. So you're generating revenue every single month and you're encouraging long-term tenancies. If your goal is to just get that quick spike in occupancy, sure, go with like a free month. Go for the first month for $1. But if you don't, whether you're doing it on your own, self-managing, or working with a manager, if your manager is not looking to customize it to meet your long-term goals and like whatever those goals are, then that's a huge misstep. So that would be how I'd answer his question.
Great. And Taylor, if you have a follow-up, feel free to put it in the chat. But Taylor said, great answer. Thank you, Melissa. Martin.
Thank you, Taylor.
Martin has a question. Hey, Martin. Martin says, what do you do in situations when in-place rents are higher than market asking rates? How do you justify ECRIs to existing tenants and forecast them? And then how frequent are you doing your own ECRIs on existing tenants? Very multi-stepped question, but how would you respond to that?
So I think you can't do the cookie cutter, right? You can't do, hey, this is the plan. Everyone gets the same plan and you just keep pushing it through, pushing it through. We do daily scrapes of rates and we look for units that are in higher demand, right? So it is true that maybe when you're looking across your entire unit mix, you're saying, hey, I'm achieving higher rates here. But the question is, where are the growth opportunities? And so I think the answer can be found when what we personally do is we look at demand. Like demand is always going to be an indicator of if something is going to sell or not. And so we might prioritize and have these preferred pricing increases on the unit sizes that are in the highest demand. That way, like if everybody's looking for these 10 by 20s, like we need to up the price on the 10 by 20s because there's not enough in this market. The other thing I would encourage you to look at is, do you offer something your competitors don't offer, right? Do you have any type of specialized storage, different sizes? Any additional features? Because quite often, like that's another way to look at how you're coming up with your rates. But I would say, yeah, don't go for the blanket approach where everybody gets the same thing, because if you're over and then you're just trying to push more, you don't want to get everybody moving out, obviously. So I consider preferred pricing on high demand units. And they may even identify a few that don't need to get any increases because they're over at current rates that they're getting in place.
Yeah, Melissa, I'll back you up on that. We look at it the same way in terms of unit by unit, and very much don't apply a blanket approach because, to Noah's point, to the trivia point earlier, the 5x5 climate control is the only unit to go down, right? And so if you look at a unit mix and the 10 by 30s are 100% occupied, but the 5x5s are 40% occupied, you probably aren't getting those units to 90%, right? And so it's about, I completely agree with you in that regard in terms of a unit by unit approach.
Yeah. And to your point, and to the trivia, if you have a bunch of 5x5s that aren't renting, look at options to combine those spaces, make them 5x10s, right? Like if you see that the rates are higher for 5x10s, why not?
Yeah.
There's always opportunities. It's just, tapping into them. So
Yeah.
that was a great question though. And yeah, so, that's really what we look at, right? So job one, we're going to drive this economic occupancy. We are going to recapture this money that this property should be bringing in. We're going to roll out our ECRIs. The biggest thing with us is we're trying to generate healthy leads before we roll out the increases, right? We want people like locked and loaded, ready and wanting to rent there before we just start putting through rate increases because we know it's going to generate some churn. And we're trying to bridge that gap, right? Like we're bridging the gap between where we are now and market rates, right? You're not gonna just do it overnight. So that's why you have to have a well communicated, clear, compliant plan that you roll out for your ECRIs. For
Could I
this
ask another
property,
question, Melissa?
sure, Noah.
Two questions. The first is, did Storage Pro approve to be able to manage this deal if someone wanted to buy it? And then the second question is kind of what you described. How automated is revenue management for Storage Pro? Because the way you describe it is like taking a very granular, like methodical, individual customer approach, which I think makes a ton of sense, right? Because every customer is different. But how I think a lot of people are trying to like automate revenue management. And
Yep,
I'd be curious
100%.
how you would answer, how you would think about that.
So I'll answer the first one. To anybody who decides to buy this property from Cole, 100%, come talk to me. We would definitely manage this property. Simple question for that one. No, we are automated when it comes to revenue management. We don't really have a bunch of people sitting in a room with pencils and paper and like writing all this stuff down. So what happens is we do the daily rate scrapes and it identifies outliers. And I won't like do the full spoiler alert before we get down to like tenant, but I will say this, integrated software. It all comes down to integrated software. And that's what we're all about. Like the more seamlessly all of your software works together, the better it is for the owners, right? You get better data, you get better information. And I mean, we have it down to, we also have like an internal training program too. So even when a store manager was to go into Hummingbird, they could easily see where there are like gaps in available opportunities. But it comes down to that integrated software. So no, it is all integrated. It goes through. We do have oversight though. We wouldn't be great managers if we didn't have a team, revenue management team that provides oversight to all of this across the entire portfolio. Okay.
Fantastic.
So the other thing, I don't want to miss anything. We good if I move forward now?
Go for it. This is awesome.
Okay. Yeah, I appreciate you. So the other thing we noticed with this one is there's some revenue streams that could be captured. One is, quite often with mom and pop, and this is no dig on any mom and pop, but it is hard when you own the place and the people coming in, they're like, I'm so sorry, I'm late, so you kind of push through with maybe not capturing some of the fees you're supposed to, or maybe it's just like, a checks and balances, right? So we need to make sure that like we look at application of fees. We want to make sure that they're consistent. We do like to roll out tenant protection plans. That's a lot of revenue that's being left out there. So one of the things is we have just under 90% participation across our portfolio in the tenant protection plan. And it's because everyone on our team can speak to the value of the coverage. Our call center can speak to it. The store managers can speak to it. Even our website can speak to the value of the coverage, right? And I think if you're going to offer a revenue stream, then you should be able to show the person purchasing it, what's this value? What am I really getting? So there's definitely revenue being left on the table again there. And so because of that, we would definitely want to capture these revenue streams and start earning some extra money. And again, this is all like the Hummingbird. You can sign up for the insurance right there. You could do everything, all this integrated tech, right? So we got the team and the tech working together. They're seamlessly working together to do this for the owners.
Yes, Melissa, thanks for doing my job for me. I forgot to mention that. The no tenant insurance, low late admin fees, no merchandise sales. So correct. The seller has never implemented tenant insurance or protection.
Yeah. And those are all great revenue sources, right? And so if there's additional money that can be had, I mean, that's a job of the manager, right? Like we should be able to find these sources for you, present them to you, explain them to you. We should be able to communicate the value of those to you. And then our team is all fully trained to sell it so that all the tenants understand the value as it relates to these additional things. So then, of course, we're going to realize potential revenue. And so this one is, I guess I'll call it the icing on the cake, right? So we've done the first two. This is the other opportunity that I noticed when looking at this property is one, we want some billing consistency, right? This comes with, we have an experienced accounting team. We standardize our leases. We integrate this amazing tech. All of these things are working together because we want to have consistency in how we apply fees, and we want to have consistency on how people are billed. And it really helps when you're trying to track things and make sure that nothing falls through the cracks. And then we want to be proactive when it comes to like delinquencies, right? So we would 100% do an audit on this one. And then, of course, we have our team, our call center does this, our store managers, and our website. We're encouraging people to do auto pay, right? Because we want everybody rowing in the same direction. Like we're trying to make sure we're generating revenue. We don't want units filled. We want units paying and bringing in and money and increasing the NOI. And of course, because we have this great tech, because we have these great teams, we know that we're compliant, right? So we're compliant with lien laws, and we have effective enforcement of liens when it has to come to that. So like those are our growth opportunities. Awesome. Yeah. Appreciate it. And then, here's just some data. The next thing you see is like, we're looking at annual growth. Like I said, we're balancing it with tenant satisfaction. We're balancing with reputation management and rollout. So this NOI growth at 17.35% is very realistic. And, the property, we're adding in additional things that they don't have now, right? So it isn't just, hey, we bumped up the revenue. Like there's more expenses now because we're giving them a bunch of things they didn't have before, but they're still going to be able to achieve over 17% annual NOI growth. The auxiliary revenue that we're talking about is over $26,000 a year that's being left on the table. And then of course we have some monthly leakage, which obviously we would want to avoid. So for us, we're going to deploy those 3 growth opportunities. And truthfully, this next section is about like, hey, what's going to be the intervention? And this really comes with a planned rollout. As soon as somebody signs with us, like we start designing like a customized rollout plan. So on day 1, like we're going to hit the ground running because you don't want to lose any more time, right? When you're talking about money, time is money, as they say. You want to make sure you have this plan. So this is like a plan that we would roll out for this property, right? We're going to get that delinquency audit done. We're going to immediately jump into standardizing the billing and fees, launching the auxiliary revenue, like that happens day 1. And then those first couple of months, right, we're going to look to do those scrapes, and we're going to look at where opportunities are, get our rate corrections in place, address the under earning units, specifically, and plan the execution of our ECRIs. And then of course, in the next section you see here, we're going to implement the rollout. The next thing that we're going to do, which obviously isn't totally about revenue management, obviously we're always looking to maximize operational efficiency, right? I mean, we're going to do the whole thing when it comes to management. So that obviously is a key point that we do as well. And then, we got to look at things that aren't related to just rates. Where is the other growth for this property? And that's kind of what, once you're with a manager for a long time or people who've been managed, like that's really what good managers do, right? They fix the rate problem, but then they got to figure out how else can I make you grow?
Melissa, that was fantastic. There's a bunch of questions, but what I'd love to do is transition to Tim and Karan from Tenant so that we can take the learnings and all of your experience and wisdom here and how would this be applied in actual software? And what does the Hummingbird experience look like? And then if we have time to answer these other questions, I also built something cool while you were presenting, so maybe we'll have time, but we definitely have announcements and things. So thank you so much. But let's transition, Karan and Tim, if y'all are ready for us.
Yeah, thanks, Noah, and thanks, Melissa. I mean, obviously, excellent analysis of this property. I think anyone would be eager to get their hands on it. And Melissa's right. When you combine like very strong operational excellence on top of a tech stack, you can really make magic happen at a property. And you have partnerships that go along with your tech stack, for example, like we're here talking with TractIQ and the power of TractIQ and Tenant. We've just released all of the street rate, competitive analysis, rate analysis, historical trends. All of that now lives directly in the FMS, which is huge. So we're absolutely going to show the application of some of Melissa's strategy in the technology, things like rate comparison in your market. We're going to show it on this property. We're also going to show you how that naturally just rolls into the rent increases and the historical trends within the region. And then we can show you a couple of other cool tricks where we've had some questions come in about like, what happens if you're above or below sell rate? Well, I guess the first question is, how do you know, right? And your technology should be, serving up the insight and the data that you need. So, Karan, I'm going to turn it over to you and have you kind of take us through the tool set. And I think it'd be great to start with, competitor analysis.
Absolutely. Thank you, Tim. Welcome everyone to the Tenanting homepage. So when you log in into the Hummingbird software, this is your homepage. From your homepage, we go to tools and you will see a competitor analysis tab over here. When you click on it, you can select your property and then you can select your number of miles. You can select between 1, 2, 3, 5, 10. Let's go with 5. And you have the ability now to like look at all the nearby properties that you have. You can look at their address, phone number. You can, if you want to just take a quick look at how their website looks like, you can just click on view website and it will open their website in a new tab. So you can go and like quickly look at everything. It will also tell you what is the distance of the property from your property. Out of all the sizes that they have available, how many of them match with your property sizes? If it is, if like there's any particular management type, it would tell you that. What type of units this property has, drive up, indoor, multi-story, all of those. If they have any climate control units, then they would show up here how many stories they have, total rentable square feet, if they are under construction or not, and when was the last refresh of rates that we have done for them. And once you select your properties, you have the ability to save them. So like if I want to add like one more property, I can just click on it and save it. If I feel like I no longer want this property to be visible or for my competitor analysis, I can just click on it and remove it and save it again. Once you have selected all your locations, it would like show up a quick dashboard over here, which shows like what is your current average occupancy, how has it changed in the last month, what is your average sell rate, and like how has that changed since last month, and then what is your average competitor sell rate, and if it is higher than yours or if it is lower than yours. And then right below it is the comparison table. So in Hummingbird, you have the ability to configure all your features and amenities by your spaces. And based on that, you can create the space groups. And whatever groups you select, against that group, you can look at your competitors' performance. Like for example, this is the same property that we were talking about. It's like 95% occupied. You can see their occupancy percentages by space group. What is your average sell rate, like your market rate? For these groups, and against your competitor average sell rate, like are they selling it at a higher price or a lower price than yours? And if you want to look at specific competitors, then you can see it over here, like against specific competitors as well. You can switch between your sell rate or dollar per square feet. So like if you want to go granular and see that you are at 1.68 and your competitors are at 2.30. So that just helps you if you want to look at metrics like overall dollar per square feet for your property. Also, another important thing is that if there are any space sizes that your competitors have or space groups and they are not present at your property, they would show up below over here. And if you're planning to like do any construction or introduce anything, it can give you relevant information.
Ron, I just want to chime in on this piece really quickly because I think this ties really well to one of the statements Melissa made, which is, we got to do an audit. We need to do an analysis. And this tool could very quickly show the operator that says, as you can see, your space mix is consistently below the average of your competitor, which shows the ancillary revenue gain that you may be able to pick up by introducing some of the strategies that Melissa just mentioned. And you could do that based upon proximity to the competitors in the market, which is all very easily accessible in the PMS that you're going to be operating those changes in as well.
You can also download this if you want to like work on it offline. Like you can just click download and it will download a CSV for you. I'll pull up the CSV right over here. Just 1 second. I'm using a large screen. Let me just enhance it. But here are all your space groups, like what is your occupancy, sell rate, and your competitors, and what is the average competitor sell rate against it. Going back to the software, it also lets you like pick up if you want to see your competitor trends, you can see that. You can select like, a time frame. You can select the properties against which you would like to see your competitor trends. And like you can see how the prices have been moving along. So if you hover
Awesome.
over, yeah.
Which is really interesting to that trivia question. Look at that trough. It's right there in that October time frame
There
that
you
kicked
go.
off this meeting. So
That's right. There are a couple of questions, but this is awesome, and we're excited to finally have the integration live and be partners together. Obviously, a lot of respect for the leadership and the whole team at Tenant, and this will be really, really awesome and valuable for operators. There was a question: how often does the data refresh? The data refreshes from the TractIQ side every day, and then if you're using Hummingbird, I think the right answer would be to talk to Tim or your team at Hummingbird, because depending on your plan, you can customize all sorts of things. Is that a fair characterization, Tim?
that would be accurate. Yep. And what we found is that most operators opt for like a weekly refresh just to make sure that they're getting in on whatever day a week they choose to do their rate management, to refresh the data and scrub the street rates.
Awesome. And there were some other questions here. So, at least in Hummingbird, is there a way, so like you take all of this data here,
Mhm.
then you would go somewhere else, and like where do you actually change rates, and like how automated could it be to do that in Hummingbird?
Yeah, great. Karan, if you want to open up the rate management and we'll show exactly how you change that. And the beautiful thing is that this is the first wave of our integration. Before the end of the year, there'll be suggested rates that are right there in the competitive analysis tool that you can choose to adopt or decline. So you'd be in one space come 27. But for now, you would just hop over to rate management, select the space group, and edit the rate that you choose.
And I just want to point out that you can put the exact same space group that you're using for rate management and you're using for competitor analysis. So you can see a group to group match. Like for example, let's try and change rate for this particular space group, which is 5x5 interior access and ground floor. So here is the space group in rate management, interior access, ground floor. The sell rate is $49. So I would go over here. I would click edit sell rate and like I would change this to like, let's say $55. And I'm going to change the rate. And you can see against this, now it is $55. If I'll go and refresh competitor analysis, it should usually take like a couple of minutes. Let's see if it is available. You can see over here, immediately you can see $55. And now you can see the new comparison exactly. Like it was $49. This percentage was, I believe, around like 20% or something. It's now 5%. So like it gets reflected immediately over here, immediately on your website, everywhere.
Great. And it looks like our friends Dana Elefante, I think from Platinum, if I'm not mistaken. Where will this data appear in reports? For instance, we might want to see some competitor data on MSR or management history reports.
Yes. So
You want to take that one, Karan?
yes, absolutely. So at the moment, we do not have this data on management summary, but in the very next phase, we will be seeing like whatever properties you have selected in your competitor analysis over here, an average competitor rate for that would be visible in your management summary as well as your management history reports.
Yep. In addition to that, we also have an MCP with Claude. And
Yeah.
so if you have our tenant intelligence platform, you can just ask Claude to build you the report that says, show me my MSR report compared to my competitor data by space group. And just like what Noah was showing you all with the TractIQ information, you can build that beautiful, beautiful report by using your LLM of choice.
Yes.
Love it. Okay, we have a couple more questions. What I'd like to do is go over some announcements in case some folks have a hard stop, and then we can, as a group, there's another question for Melissa, and then there are, I think, some more questions for Tim and Karan, if that works for you all.
Works.
All right, so let's talk through some announcements first. So following this call, as always, we will share the recording so you guys can rewatch it on your own time. We're also going to share Melissa's document that she was just walking through. Tenant has a document, and then we also have, I think we'll also share Cole's OM or something. Will we share the OM for the deal?
Yeah, yeah. Again, and the deal is live on TractIQ as well. So
Awesome. Yeah, more in an exciting fashion. If you're a TractIQ customer, again, this deal is live right now. I don't think anywhere else other than here, but yeah, you could actually click into the deals, and here is the deal. You got the pricing guidance, and of course, a lot of information on this call. So hopefully, if any of you actually submit an LOI to Cole, send me something because I want to send you something. Um,
deal.
but a couple other announcements. We're going to be at SSA in 3 weeks or so. So excited to see many of you there. And we may or may not have a money machine at our booth. And so we may or may not have a money machine, which would mean that we may or may not give you actual money if you come to our booth. So definitely don't come to our booth at all. And definitely don't reach out to us for coffee, drinks, dinner, all the good stuff. But we'd be very excited to see all of you at SSA. The next webinar for TractIQ for the smartest hour in self-storage, we are going to be releasing a data set that genuinely has never existed in the history of self-storage. I'm really excited about it. So you're definitely going to want to tune in. That webinar is on September 23rd at 1 p.m. Central, where we will be joined by 3 incredible companies and 3 incredible groups. Again, I can promise you, data has never been possible before. So we'll see if it lives up to the hype, but you guys be the judge on if our stuff lives up to the hype. And with that, Nikki, is there anything I missed on announcements before we come back to these questions?
If you want to point them to the resource on the Interactive Hub, I think that's
Oh, of course. How could I have done that? Or how could I have forgotten that? So if you are a TractIQ customer and you go in your dashboard in the bottom left, it would take you to the Interactive Data Hub. For this episode, a couple things. One, we're dropping our REIT report tomorrow. That means that this REIT dashboard has been totally updated with all of the REIT data. It's pretty awesome. Definitely encourage you to look at it. The second is for this webinar, Taylor put together an awesome rate analysis tool for the entire United States, looking at top 50 MSAs. We put together, you can look at each unit sizes, look at climate control premiums, historic rate trends, demand indicators, seasonality, rate dispersion, lots of really great stuff. So if you're a customer, you can just click that. If you're not a customer, you can access that for free. So all you need to go to is the tractiq.com/interactive data hub, and you can get that for free. Thank you for pointing that out, Nikki. Anything else before I dive into these questions?
I think you covered it.
Outstanding. So I think Craig Nieman asked this question to Melissa. And I know we're going to probably go a few minutes over. So I just want to be mindful on time, but we'll go a couple minutes over. Melissa, how is AI being integrated into your revenue management automations today?
Okay, so I want to preface this by saying I am not the world's AI expert. Okay, we're smart enough to know when we need to tap into other resources, and that being obviously our revenue management team and our technology. But specifically, it was when the rates come in. I'll give you my basic understanding of it, and I can always get more information. And what happens is the daily rates come in, and then AI goes through and analyzes to see these outliers, right? Like we're looking for outliers and opportunities. And so we actually have like a full internal team that does it, and we built out our own AI agent within the company that integrates with our software platform. So very similar to like what you modeled when you were like, hey, go through and do this. Like that is what our business intelligence team did at StoragePro. I'm not sure if that's going to fully answer the question, and I'm happy to get more information. But the truth is, you got to know what you don't know. And I'm not a tech and AI expert, but we know that we hire the right companies and the right people that do know the information.
Awesome. I'll just take a crack on this. While we were chatting on this and I saw, Craig, your question, I just asked Claude to build me a revenue management dashboard based on this deal, assuming I was to take over tomorrow. Here's what it built based on TractIQ's data. If you're a Hummingbird customer, you could ask it to also pull the tenant MCP at the same time. And then to your question, Dana, build something like this that incorporates all the tenant data and all the TractIQ data. And then when you go into Hummingbird, you can have this be informing all of your stuff. And I imagine, you could send this feedback to Tim and Karan because they're going to be constantly improving. But kind of like to your question, you could I just pulled all of this, looking at all the unit sizes, and then you can kind of like, it built this artifact that I can kind of customize all my stuff, looking at turnover, ECRI increases per wave, even though Melissa had really good commentary about how you should think about waves. But all of this like stuff, 5 years ago would be hundreds of thousands of dollars to build. It's now at your disposal if you have the right data. So really, really awesome. The next question, I think, was for both of you. I would actually pose this to Melissa, of like, how soon do you implement mandatory tenant protection? And then for Tim and Karan, like, how easy is it to implement mandatory or optional tenant protection?
Yeah, right out of the gate, right? Like we're going to get everybody. If we took over the property tomorrow, this one doesn't have tenant protection, so we would still be rolling it out. And of course, with any tenant protection, as long as if they have other insurance in place, and it meets the requirements, and they could give us a deck page, and they don't have to do it. But right out of the gate, we roll it out. There's no reasoning to phase that out over a set amount of time.
Yeah, I would absolutely agree with Melissa on that. I think that also when you couple that with technology, you can automate the notifications that go out with the right notice periods and the increases that go along with that. And you can also leverage, automated enrollment in your software. So even if you are offering a mandatory option, it would keep everybody enrolled. If you're offering a non-mandatory option, you can keep the policy expiration dates in the software of a homeowner's declaration, for example, that might be covering their contents. And at the expiration of that declaration, the program will auto enroll them unless they show new proof of insurance. So that way the system is always focused on picking up the revenue dollars for your organization.
Yeah, and to your point, Tim, that's why the integrated technology is so important, right? Like it gets rid of the human error, right? Like that's where things don't fall through the cracks, and you find out that you have a leakage problem, and the technology makes sure that doesn't happen.
Awesome. A couple other questions here. I realize I didn't answer Dusty Lucy's question. We love Dusty. Does the manager live in the two-story building at the property? And then how competitive do you think this deal will be? And how, for all the folks on the phone that are interested in the deal, like, is it a call for offers or how fast should they be moving?
Yeah, the manager does live on site. The manager is aware of the sale. And I don't think we'll be continuing on post-sale. Just FYI there. We do anticipate this being a competitive process, just due to kind of everything that we mentioned on the call, the high occupancy, the low than market street rates, the barriers to entry, etc. So this will be a call for offers. We are officially going live on Wednesday. What is that, the 26th? I can't think if that's something pulled up actually. And the call for offers will be Wednesday, September 23rd. So there's no immediate rush on that. We do plan to see that through and collect offers on that day. So,
But if someone on this call sends you a full priced offer before that date,
we plan to run the full process.
okay, that's the right smart man. All right, a couple other questions here. I see Robert Madsen. Good to see you. You have your hand raised. I just wanted to give you an opportunity if you had a question. If not, I'll start with someone asked if it makes sense to use our services for small facilities between 15 and 20K. I'm not sure for TractIQ, definitely talk to us, but I'd be curious both for Melissa and Tim and Karan, like, do you guys work with smaller operators as well?
Yeah. I mean, we have a remote model, right, that we look at because a lot of these smaller facilities can be run remotely or hybrid. And we do have like a minimum, management fee. And really, it's not always the size of your facility. It's really like, what are the rates doing, right? So, like, you could have a big facility that's double that size, but if the rates are 50 cents, like, we got a problem, right? Whereas, like, you could have a much smaller facility but the rates can support it. So I really do think when it comes to professional management, you need to consider, obviously, the expense, but you need to look at it from how much revenue are you generating? Does it make sense? And I'm the first person to always say, like, if it's not a good deal for you, then I'm not going to try and encourage you to do it. That doesn't make sense. So that's how I would answer it. It would really depend on it, but just being small does not necessarily knock you out of the running for getting professional management.
Yeah,
Awesome.
I would say on our side, on the software side, we are size agnostic, especially with some of these smaller assets having the need to be remote managed just because the cost structure doesn't match unless they are properly managed with the cash flow that the owners are looking to get out of them. So we certainly have properties in that range that are on our tech stack today.
Outstanding. Well, I think we should call it a wrap. I just want to thank Cole, Melissa, Tim, Karan, and everyone on this call for joining. We love, love, love talking about storage and data and technology. Excited to see many of you at SSA in a handful of weeks. Don't be a stranger. Come say hi, and hope everyone has a great rest of your week.
Thank you, Noah.
Thank you. Thank
Yeah,
you.
thanks everybody.
Thanks, guys.
Thanks, everyone. Have a great day.
Good one.